Turn on the financial news right now, and they'll feed you the same comfortable story. The 2023 banking meltdown that took down Silicon Valley Bank, Signature Bank, and First Republic? Just a one-time disaster, bad luck. A handful of careless executives who bet wrong. They'll assure you everything's been patched up, regulators jumped in, and something called the Bank Term Funding Program swooped in to rescue the day. Don't believe a word of it. The truth, that banking crisis never stopped. It just moved into the shadows. The same toxic math that destroyed SVB is quietly eating away at hundreds of regional banks right now. But it's invisible to you because the government gave them permission to fake their numbers. What we're seeing isn't a stable system. We're watching the biggest financial cover-up in history unfold in real time. And to grasp why your bank might actually be broke right now without anyone knowing, you need to understand something called the bond trap. Back in 2020 and 2021, during the COVID pandemic, banks got hit with a tsunami of cash from all those stimulus payments. Deposits went through the roof. All that money had to go somewhere secure, so banks did exactly what they're meant to do. They loaded up on safe U.S. Treasury bonds and mortgage-backed securities. Sounds smart, right? Here's the catch. They bought these bonds when interest rates were basically nothing 0.5%, maybe 1% tops. Then the Federal Reserve cranked rates up to 5.5%, trying to crush inflation. That's when basic bond mathematics kicked in with brutal force. Rising interest rates mean falling bond prices. Think about it. A 10-year Treasury bond paying 1% becomes worthless junk when someone can buy a fresh bond paying 5%. Nobody touches the old one unless you're willing to slash the price talking 20% to 30% off what it's supposed to be worth. Here's the scary part. The FDIC's own numbers show American banks are currently stuck with over $500 billion in unrealized losses from this exact problem. If these banks had to dump these bonds today to give depositors their money back, they'd be completely wiped out. On a real market valuation, they're not actually solvent. So why haven't they crashed yet? Because there's a regulatory magic trick called held-to-maturity accounting, or HTM for short. Current rules say if a bank pinky swears not to sell a bond if they label it as held-to-maturity, they don't have to show the actual market loss on their books. They can keep pretending the bond is worth full price at $100, even though the market would only pay $70 for it. It's complete fantasy accounting. This loophole let the entire banking industry ignore reality for 2 solid years. But then March 2023 happened and SVB's depositors wanted their cash out. To pay them back, SVB had to sell those held-to-maturity bonds. The second they sold, those paper losses became horribly real. The money vanished and the bank collapsed in 48 hours. The government's answer was the Bank Term Funding Program, the BTFP. This was an emergency plan where the Fed let banks use their underwater bonds as collateral, the crucial part. The Fed valued these bonds at full price $100 instead of the actual market price of $70. It was a hidden bailout that covered up how broke they really were. It bought them 1 year of breathing room. But here's your proof the crisis is still very much alive. The BTFP shut down in March 2024. That lifeline got cut. Banks can't use those underwater assets at fake prices with the Fed anymore. So where are they getting cash to survive now? They've quietly switched to something called the Federal Home Loan Banks, or FHLB. The FHLB is supposed to help with housing loans. Instead, it's become the emergency lender nobody talks about. Throughout late 2024 and into 2025, regional banks started aggressively borrowing from FHLB. This is shadow financing. It doesn't have the bad reputation of borrowing from the Fed's discount window, but it serves the exact same desperate function. It keeps zombie banks liquid while they pray interest rates drop. The real danger now is something called cash sorting. This is the silent bank run happening right under our noses. For the past 10 years, depositors got lazy. Everyone left money sitting in checking accounts earning practically nothing 0.01% because there weren't better options. Now you can grab 5% in a money market fund or a treasury bill without breaking a sweat. Depositors are finally waking up. Billions of dollars are flowing out of regional banks into these better investments. Every single dollar that walks out the door forces the bank to drain its reserves. If the money leaves slowly, the bank bleeds out over years. That's a profitability crisis. If it leaves fast, the bank hits a brick wall. That's a liquidity crisis. Right now, the regional banking ETF called KRE is flashing warning signals. The gap between the massive banks like JP Morgan, who are swimming in cash, and the small banks who are hemorrhaging deposits keeps getting wider. The system is splitting in two. The giants who are too big to fail are getting even bigger, while the ones too small to matter are being kept alive with accounting tricks and secret loans. But the underlying math of the bond trap hasn't budged. That $500 billion hole is still there. And as we're about to see in the next part, another massive hole is tearing open in the one thing these regional banks are most exposed to: commercial real estate. The bond trap we just talked about is like a flesh wound. It hurts badly and it's bleeding. But if a bank can somehow hold on and wait for those bonds to mature in 10 years, there's a chance it survives. But there's a second bullet wound in the chest of American banking that can't be waited out. This is the one that's actually going to kill the patient. It's commercial real estate, CRE for short. To understand why this is the fatal blow, you've got to understand how regional banks think. After the 2008 crash, the massive too-big-to-fail banks JP Morgan and Bank of America mostly backed away from lending money for strip malls, office parks, and downtown towers. Regulators made it too expensive and complicated for them. So who jumped in to fill that gap? Regional banks. Banks with anywhere from $10 billion to $100 billion in assets went all in on commercial real estate. Federal Reserve data shows small and mid-sized banks now hold nearly 70% of all commercial real estate loans in America. For many of these banks, CRE loans make up 300% or even 400% of their total capital. This massive concentration was perfectly fine when interest rates were zero and every office building in America was packed with workers. But here in 2026, we're staring down a double disaster. First, the work-from-home revolution permanently killed the demand for office space. In big cities like San Francisco, Chicago, and New York, the real vacancy rate, including buildings where tenants are paying rent but not actually using the spaces, hovering around 30%. A building that's 30% empty isn't just making less money. It's mathematically bankrupt. The rent coming in can't cover the mortgage, property taxes, and insurance costs. Second problem, the interest rate shock. Commercial loans aren't like your standard 30-year fixed home mortgage. They're usually 5-year balloon loans. The borrower pays interest for 5 years, then has to refinance the whole thing. Right now, we're slamming face first into what's called the maturity wall. About $1.5 trillion to $2 trillion of these loans are coming due between 2025 and 2027. These were written back in 2020 and 2021 when rates were around 3%. Now borrowers have to refinance at 7% or 8%. The math is absolutely catastrophic. The building is making less money because of vacancies, but the mortgage payment is literally doubling. The borrower simply can't pay it. They're mailing the keys back to the bank and walking away. In a normal free market, this would cause immediate bank failures across the board. When the borrower gives up, the bank takes ownership of the building. The bank then needs to sell that building to recover its cash. But here's the terrifying question. What's an empty office tower actually worth in 2026? We've seen the few real transactions that slipped through. The Aon Center in Los Angeles sold for almost 45% less than what someone paid for it before. Buildings in San Francisco have sold at 60% to 70% discounts. If a regional bank has to admit to a 50% loss on its loan portfolio, its capital gets wiped out instantly. It's bankrupt on the spot. So why haven't hundreds of banks failed already? Because of a quiet conspiracy called extend and pretend. People in the industry also call it delay and pray. Here's exactly how it works. A borrower calls the bank and says, "I can't refinance this $50 million loan on my office building. I'm going to default." The bank manager pulls up his spreadsheet. He knows if he takes the building back, he has to record a $25 million loss. That loss will alert the regulators and could shut the whole bank down. So instead, the manager says, "Tell you what, we're not going to force you to pay back the principal. We'll extend this loan another 2 years. We'll even keep pretending the building is still worth $50 million. They tweak the loan terms just enough to keep it classified as performing. The borrower stays alive. The bank stays alive. But the rot inside the balance sheet gets deeper and deeper. The bank is now carrying a zombie asset. It's listing a $50 million asset that's really worth $25 million. This is mark-to-myth accounting. It's exactly what Japanese banks did in the 1990s, which led to their lost decade. It turns the banking system into a hollow shell that can lend to new businesses because it's drowning in old bad debts. The regulators are helping with this deception. The Federal Reserve and FDIC are terrified of causing a panic. They know if they force banks to show the real market value of their real estate loans today, half the banking system would be revealed as insolvent tomorrow. So they're practicing what's called regulatory forbearance. They're intentionally looking the other way. They're publishing guidance that encourage banks to work with borrowers. That's code language for don't foreclose, don't reveal the true price. We're essentially in a silent bailout right now. Instead of using taxpayer money to rescue the banks directly, which is political poison, they're letting banks hide their losses and gamble that they can somehow earn their way out of this hole over the next decade. But there's a fatal flaw in this strategy. It assumes depositors will just sit there. It assumes you won't notice your bank is a zombie. This brings us back to the liquidity drain problem. Even if regulators don't shut down the bank, the market can do it instead. The smart money hedge funds, family offices already sees the extend and pretend game happening. They're betting against regional banks through the CRA index. And crucially, they're pulling their deposits out. When a bank loses deposits, it must sell assets to raise cash. You can't extend and pretend when a depositor wants their money back in actual cash. This forces the bank to sell the only things it can: its bond portfolio at a loss, or its real estate loans at massive fire sale prices. Once the selling begins, the mark-to-myth fantasy evaporates. The mark-to-market reality becomes unavoidable. That $2 trillion maturity wall is the catalyst forcing the selling to start. Every single month, billions of dollars in loans hit their expiration date. Every month, the extend game gets harder to keep playing. Borrowers are running out of cash reserves to even pay the interest anymore. When the interest payments stop coming in, the bank can no longer pretend the loan is performing. Non-performing loan ratios are just starting to creep upward. This is creating what I call the jaws of death chart. Rising delinquencies meeting falling reserves. We're currently sitting in the eye of the storm. The BTFP is gone. The FHLB is maxed out. Office buildings are still sitting empty. And the Fed is keeping rates elevated for longer. The banking crisis didn't end in 2023. That was just the preview trailer. The main movie is starting right now. And unlike 2008, where the bad assets were complicated derivatives nobody understood, in 2026, the bad asset is literally the building you walk past every day on your commute to work. It's a $2 trillion problem hiding in plain sight. And in the next section, I am going to explain exactly what happens to your money when one of these zombie banks finally collapses, and why that FDIC insurance limit of $250,000 might not be the safety net you think it is. If the bond trap and the real estate maturity wall are fires burning the house down, the FDIC is supposed to be the fire extinguisher that saves you. From the time we're kids, we're trained to trust that member FDIC sticker on the bank door. We believe that no matter how reckless the bank is or how much money they lose on terrible loans, we're protected. Here's the math they don't want you doing. According to the FDIC's latest quarterly reports, the Deposit Insurance Fund, the DIF, holds roughly $130 billion. The total deposits in the U.S. banking system? Over $17 trillion. This means the FDIC has less than 1 penny for every dollar of deposits it supposedly insures. This reserve ratio works fine for handling the failure of a couple small banks in Kansas or Oklahoma. It functions when failures are random and isolated. But in a systemic crisis where a dozen regional banks collapse at once because of the commercial real estate implosion we just discussed, that fund hits zero immediately. When the fund runs dry, the FDIC has to go begging to the Treasury for a bailout. That requires Congress to pass legislation. And as we all know, Congress isn't exactly famous for moving quickly during a financial meltdown. This brings us to the most dangerous legal concept in modern finance, the bail-in. Most Americans think if a bank fails, the government executes a bailout. They print taxpayer money to plug the hole. But the public rage after 2008 made bailouts politically untouchable. So in 2010, Congress passed the Dodd-Frank Act. Buried inside Title II of that law is something called the Orderly Liquidation Authority. This law effectively made bail-ins legal. It says that when a bank fails, the FDIC can recapitalize the bank not just by selling off assets, but by writing down the liabilities of unsecured creditors. Here's your wake-up call. You are an unsecured creditor. When you deposit money in a bank, legally you're loaning that money to the bank. You don't actually own the money in your account. You own an IOU from the bank. In a bail-in scenario, regulators can grab a portion of your deposits, anything above the insured limit, and convert them into stock. You go to bed with $500,000 in your checking account. You wake up with $250,000 in cash and $250,000 worth of shares in a bankrupt bank trading at zero. This isn't some wild conspiracy theory. It actually happened in Cyprus in 2013. Depositors in Cypriot banks had their accounts cut by 47.5% to save the system. Regulators worldwide, including the FDIC and Bank of England, didn't view Cyprus as a disaster. They saw it as a blueprint. They published white papers celebrating how efficient the bail-in mechanism was. Yes, they did. But they did it by invoking something called the systemic risk exception. The Treasury Secretary, Fed Chair, and FDIC Chairman voted to break the rules because they were terrified of nationwide panic. But here's the trap. The systemic risk exception is discretionary. It's not automatic law, it's a choice. If your small regional bank fails and the government decides its collapse doesn't threaten the global economy, they have zero obligation to save your uninsured deposits. They rescued the venture capitalists in Silicon Valley because they were politically connected and made a lot of noise. Will they rescue the small business owner in Ohio? History strongly suggests no. This creates a two-tier banking system. On one side, you've got the GSIBs, global systemically important banks. JP Morgan Chase, Bank of America, Citi, Wells Fargo. The government has basically admitted these banks can never be allowed to fail. They have an unspoken government guarantee. On the other side, you've got over 4,000 regional and community banks. These banks are now walking time bombs. If you keep your money in a regional bank, you're taking stock market risk for savings account returns. You re-risking 100% of your money for a 4% yield while the bank gambles on commercial real estate. This is fueling what I call the Great Consolidation. We're watching the slow-motion takeover of U.S. banking by the Big Four. As depositors wake up to bail-in risk, they're fleeing small banks and moving money to the giants. This is exactly what the system architects want. Regulating 4 massive banks is way easier than regulating 4,000 small ones. It also clears the path for the ultimate control system, the central bank digital currency, or CBDC. If the regional banking system collapses, the Federal Reserve will likely step in and offer Fed accounts directly to regular people to guarantee safety. This solves the bank run problem because you can't run from the Fed. They literally print the money, but it ends financial privacy forever. So what's the smart response to this hidden crisis? How do you protect your cash without stuffing it under your mattress? First, respect the limit. Never, under any circumstances, keep more than $250,000 in a single bank. If you've got a business payroll of $500,000, you're exposed. You need to use sweep networks like IntraFi that automatically spread your cash across multiple banks to keep every dollar insured. Second, Treasury Direct. The safest place for cash right now isn't a bank, it's the U.S. Treasury itself. By buying T-bills directly or through a money market fund holding only government paper, you're eliminating bank counterparty risk. You own the asset directly. If the bank fails, your T-bills are segregated and protected. They can't be bailed in. As much as we might hate the mega banks for their politics or their fees, in a crisis, size equals safety. J.P. Morgan has a fortress balance sheet and the unspoken backing of taxpayers. Moving your operating money to a GSIB is a defensive play against the regional bank collapse. Fourth, outside money. Physical cash actual paper bills also plays a critical role. In a bank holiday, when the websites go dark and ATMs stop working, cash is the only thing that buys food and gas. The banking crisis of 2026 isn't about whether banks will fail. It's about who pays when they do. The government has already signaled they're out of money. The FDIC fund is pocket change. The bond trap is real. The commercial real estate maturity wall is hitting right now. The only money left to fill the hole is your money. The laws are already written. The mechanism is ready and waiting. The extend and pretend phase is ending. The bail-in phase is coming. You've been warned. Check your balances, check your exposure. And don't trust that sticker on the door.